Well, good evening and welcome to another episode of The Money Show. I am Snehi Shah, and today we're diving deep into a topic that's on the minds of many investors, especially in the current climate and market volatility. As the Indian stock market has seen its ups and downs this year, many investors are feeling this pressure. The sharp market fluctuations have left some feeling fearful and others overly optimistic, both of which can lead to costly mistakes. But how can we navigate these emotional roller coasters, keep our heads steady, and build financial resilience in times of market uncertainty? Now, that's exactly what we'll be discussing in the first segment of this show today. Whether you're dealing with short-term losses or wondering how to stay calm during a market dip, today's conversation will give you the tools you need to make better, more informed decisions, even when it feels like the market is against you. Let's welcome on board Mrin Agarwal, financial educator and founder at FinSafe. And Brin, good evening and thanks so much for joining us, and help our viewers understand how do emotions like fear and greed typically affect investors' decisions during market downturns, because these emotions are at an all-time high when you're facing adversity, you're facing your portfolio going down. Tell us how investors can be subjective in their approach.
So good evening, Snehi, and it's lovely to be here with you today on this show. I think I'm coming to ET now after a long time, so it feels good to be back today.
We're glad to
Um,
have you.
I think Benjamin Franklin said it right that the investor needs to control their emotions more, and that's what's more in control of them than the markets really. So, of course, at times like this, when there is volatility, there is this tendency to take very hasty decisions to exit or to stay away from the markets. And even already with this much correction, there have been investor queries on whether you should stay invested or what do we do with our SIPs? Do I stop my SIP? And so one bit of it is this, that when markets even have a slight correction, people start getting immediately really, really worried. And the other thing is also that sometimes there's a lot of overconfidence, right? Saying that, okay, the market has fallen and I'll just invest and I'll just immediately make some quick returns as well. The other thing that one is also seeing on the other side of the market. So since we're talking about market volatility, it's not only downturn, but also on the other side of the markets, when markets are going up, there is also this tendency to look at investing in trending investments and investments with recent good performance as well. So these are a mix of things, but I think essentially what happens is that because of emotions, people tend to put a stop to their investing journey or tend to halt that investing journey, which is really not good for them in the long term.
Okay, well, point taken. But Miran, there is this term that we're very loosely hearing in the market right now. Everyone's saying it, and I'm sure a lot of people don't know exactly what it means. And it's the concept of loss aversion. Could you take our viewers through what this term really means and how it influences investor behavior, especially during times of market stress like we're seeing right now?
So, loss aversion is really a cognitive bias where the pain that an investor experiences from losing money far outweighs the benefits of staying invested, right? So they feel double pain when they're losing money compared to the high that one would feel when one is actually growing money, right? And what happens is that due to loss aversion, again, you might exit an instrument with potential. So classic case is SIP investing, right? And the classic case is 2020, March 2020, when due to COVID, markets fell and a lot of people put a stop to their SIPs, believing that, okay, now we're in some really bad times and I would rather just stop here and, take a stop loss rather than continuing further and stuff like that. But as we saw, the people who remained invested made up in the next 1 year to 3 years in such a great way, right? So essentially, what happens is that you tend to also exit good investments as well. And also, what happens in many times in loss aversion is that you actually hold on to losing investments and you basically go out and you sell the winners as well. The other thing is also, of course, due to this loss aversion, people tend to prioritize short-term security over their long-term growth. So, of course, this, as I talked about the COVID experience, it really backfired for most people, and this is what typically happens in the market. So, I think all in all, I think it just this loss aversion just makes people extremely cautious, overcautious, which they don't need to be.
Okay, well, point taken. Thanks for that. Also, take us through some psychological biases or mental shortcuts that people often fall prey to during market crashes or periods of volatility. You spoke about people trying to make a quick buck, and we know the entire concept of instant gratification when it comes to having your returns in the stock market. But at a time like this, when we're surrounded with volatility, when that instant gratification does not happen, tell us some traps or some biases that investors fall prey to.
So I think the biggest one is overreaction.
Okay.
Just believing, okay, we are at the end of the world and markets are not going to move up anymore. See, markets always revert to mean, whether it's like the excesses or whether it's the fall, it'll always revert to the mean. The question is, how long is it really going to take to get back to the mean, right? So I think the biggest impact on people during market crashes or periods of volatility is its overreaction, thinking that, okay, things will only get worse from here and things are never going to get better. But that's not the case, right? I mean, things do change. The second thing is also herding behavior, right? So you basically follow what others are doing. And, we've seen this in the market time and again, that whenever there's a slight fall, people start talking very negatively. When markets are doing well, then you'll have all these predictions saying that Sensex is going to touch 1 lakh or gold is going to touch 1 lakh. But and the opposite happens at the time when markets fall. So again, I think people do give in to all this noise and tend to just say that, okay, if others are doing it, then maybe I should also do the same. And of course, the disposition effect that I talked about, which is basically hold on to the losing investments and basically sell the winning investments.
Okay, and now that we know what kind of traps people can fall into, what are some strategies that investors can use to avoid these traps, to stay calm and avoid making impulsive decisions when the markets are declining?
So I think the first would be to stop reacting, right?
Okay.
Um, Now there's always going to be some or the other news in the markets, right? Till now it was US elections. Now that that's out of the way, you've got something else coming in. And there's always going to be something or the other that's going to be happening, right? Of course, we live in this dynamic world. And the fact is that we are living with two wars, but Indian markets are still going up. So I think, we need to really stop reacting to news and keep this noise out. I think that's number one, right? And the second thing is that, you cannot keep changing your portfolio strategy every time there's a change in the environment. So I think people who do that are taking very impulsive decisions. And certainly it's not something that works in the long term. What actually works in portfolio management, personal portfolio management, is really choosing right and remaining invested. It's like the tortoise and the hare story, right? All of this jumping in, jumping out is really not going to help you. The third thing that I think, it's very important for anybody who's feeling concerned today is to really see that how are your goals really getting impacted. So if you have done goal based investing, then how is this impacting? So for example, let's say you've been investing something for retirement which could be 20 years away. How does the current market situation really impact something that's 20 years down the line? Not really, right? I mean, it's not going to have such a big impact. So I think it's very important that you need to see how quickly you need the money, how quickly you need to draw down your money, and then what is the impact. Certainly if you need to draw down money in the next 6 months, yes, you should be concerned. But if you have 4 years, 5 years to go to draw down the money, I don't think that one should really get perturbed by this particular volatility. Of course, do not stop investing. That's the biggest mistake that you can do, because when you are investing at downturns, you're actually acquiring more units, and that's when the rupee cost averaging is really going to work in your favor. So do not stop the SIPs. And finally, remain optimistic, because remember that 10 to 15% drawdown happens almost every year, but markets do bounce back. We do see higher lows. And of course, things, despite what we're seeing right now, let's say on corporate profits or, maybe some amount of FII outflows, the point still remains that the long-term trajectory for India still remains really good. So I think important to really remain optimistic.
Optimistic is the key, and this is something that investors may develop over time. In even the most seasoned investors, there are times where they may slip and they may fall prey to one of these biases. But Miran, just on a parting note, what would your advice be to new investors, fledgling investors who've just entered their market? And imagine someone just dipped their toes into this market, let's say 3-4 months ago, on a fresh salary, is very optimistic, very excited, and is greeted with this kind of volatility and market correction. What's your advice to them?
That's part and parcel of investing. Get used to it. Life is not a one-way street, right? So the same thing goes with investing as well.
Okay, then, Rin, lastly, I want to also discuss with you. You did say that keeping an outlook for the longer term is important. So how important is it, and how can it be done? How can investors keep their eye on the long-term perspective while also facing short-term market volatility? How does one go in hand with the other? How do they strike that balance?
Yeah, it's a little difficult, Snehi, given the fact that, the last 4 years, you've only seen positive returns. And that's true for more than 70% of the investors today who've only come in the last 4 years, right? So for them, who've only seen the good times, I think they might be quite perturbed. So I think the first thing is to just keep some basic things in mind. Like, for example, it's not easy to really quickly multiply money. All good things take time to happen. So does wealth creation. So even if you've been able to multiply money in that stock or done some F&O and stuff like that, I think that's just a matter of luck. And it's not like that's going to keep repeating again and again. So I think the first thing that we have to get out very clearly is that you really need to tone down return expectations, because more and more when I talk to people, I see everybody talking about 15-20% returns. And I always tell them that I think our focus really needs to be on getting moderate returns, like expecting moderate returns like 10 to 12%, but really focusing on what is in our control. And, because returns are actually not in our control. What is in our control is how much we can invest, where, and for how long, right? And I think if we focus on that and focus on the corpus to be created, so a simple thing, for example, to do would be to keep regularly increasing the amount that you invest on a yearly basis, because that actually helps creating a larger corpus. So I would say 2-3 things. One, I think, we should moderate return expectations. That's really important. Keep in mind that the ups and downs are normal. As I said, 10 to 15% fall intra-year is pretty normal for the markets. And number three, really focus on choosing right. Now, again, I see a lot of people wanting to only do stocks, but I would say that for most individuals, identifying stocks is not easy. And I think when you have the mutual fund route, which is so well regulated and so inexpensive way to invest into as well, why not just utilize that? Plus, it's of course got the tax benefits as well. So I think combination of these factors is what is really going to help people keep the long-term perspective.
That's been a very fruitful discussion, if I could say that, for our viewers and viewers. I hope this discussion that we just had with Mrin helps you alleviate some of that anxiety that you've been facing on the back of the market volatility that we're seeing. But Mrin, once again, always a pleasure to have you, and we hope to connect with you more frequently now. And thanks so much for joining us on The Money Show.
If you like this video, then like, share and subscribe to ET Now.